Hello, everybody. Welcome to the Monica Kelly Show. We are on episode 1. And today I have a fabulous guest with me. And I'm super excited to have her here in the studio with me today. And so I'm excited to see that I at least have 2 viewers. So that's great. And it's going to take a little bit for everything to get rolling. But for the most part, I just want to say thank you all so much. I appreciate you following this journey that I'm about to begin. So be patient. As you can see, it is way past 10:30. But we're here and we made it.
That's how we roll.
That's
right?
how we roll. All right. So, hey, everybody. Again, it's Monica. Episode 1, The Monica Kelly Show. And I have Miss Madison Haltom in the building with me today. Hi, Madison.
Hello.
How are you?
Oh, I'm good. What about you?
I'm good. All right, Madison. Today, y'all, we're going to talk a little bit about what it takes to purchase a home. And I think we have a very smart young lady here, not only mentally, but she's thinking long term. And that's what attracted me to her the most. And so I'm super excited to share a little bit about her journey. So we'll let her start with introducing herself to us, and then we'll take it from there.
Well, I wanted to start and say congratulations on you launching this podcast.
Thank you.
Just adding an additional platform for you to express your successes and get your story out there.
Right.
You have so many things on your plate already. And then, of course, one more thing.
Right.
You can handle it all. But no, I'm so proud of you in doing this and taking the leap of faith to do it. And I got you a little something too.
What? Oh, you didn't have to do that.
I know, and I saw your earrings. I'm like, I almost got the earrings that you actually have on. So thank God I didn't. I got something
Madison,
different.
Thank you so much. I appreciate it. This Kendra's my girl.
I know. On your social media, all you have is Kendra Scott on.
I know. I know.
You're their biggest fan. But no, to start, with where I work at and what I do. So I'm a mortgage originator at Farmers Bank and Trust. So Farmers is a community bank. We probably have 30, 40 locations spread across Texas, Arkansas, Oklahoma, Louisiana.
Nice.
A lot of our main branches are probably primarily like Texarkana area.
Mm-hmm.
I'm sure you've seen them and you work with them. I know you do. But I started there, 4 years ago, probably. And the job kind of just fell into my lap, and it's been, wonderful ever since then. But I know we were going to talk about how we knew each other, being from Texarkana, girls. I think I probably went to school with your sons. They're a little bit younger than me, right?
Tyler.
Okay.
He's the oldest. Yeah,
and he went to Pleasant Grove. They both went to Pleasant Grove.
Correct.
Okay.
Yep.
I was trying to think what our age differences were, but I feel like I always knew who you were, but I didn't know you until you really got into the real estate industry and your social media began to grow. And, I recognized you and I admired what you were able to do on social media and grow your business off of there. So I can't even remember if I reached out to you or you reached out to me first, but I remember, some of our first conversations, we talked on the phone for like an hour, about business.
Right.
And I feel like we have a lot of similarities in the way that we, do business and the things that we expect, out of these transactions. Absolutely. And how we value, our customers. And so we kind of hit it off based off of that. But you've always, inspired me. And you empower women and you empower me every time we talk. I feel like you're a great role model for anybody in the industry.
Well, Thank you. All right. So Madison has shared a little bit about herself. As you can see at the bottom of the screen, all of her contact information is there. Please, please, please make sure you write it down. And even if you do forget, guess what? Call me. I got you. Yeah. Okay. All right. So we're going to start talking a little bit about mortgages. So tell me, what are some key factors potential homeowners should consider when shopping for a mortgage?
Oh, that's a great question, and really probably not talked about enough. So what I see a lot is when buyers are shopping around, they're shopping rates, as you should. I mean, compare, all your local lenders and see who offers you the best rate. I'll tell you, it's catchy. I mean, they'll kind of trap you when it comes to, the interest rates that they tell you. They leave out a lot of details. So for example, I had somebody tell me the other day that they are going the conventional route, and they were shopping around, and an online company had offered them like 5.5% on an interest rate for a conventional loan. We all know nationwide averages are not in the fives right now for a conventional loan.
Absolutely.
And so, they were leaving out some of the key questions that they probably should have been asking, like, what are the discount points, or what is the catch to get to this 5%? Nobody's doing loans for free. Right. And, they didn't ask, the important questions to really figure out how do we get that rate? So what lenders will do is leave out the fine details. Right. And that's the discount point. So they reel you in by telling you, the interest rate is 5.5%. You get trapped, you get your loan estimate, and it's like, oh, there's $10,000 in origination points or discount points. And it's not financially smart right now to pay that much. Right. You're never going to make it's prepaid interest up front is what the discount points are. Right. You're going to refinance in a year probably when interest rates, go down. You're never going to make that money back. So understanding the right questions to ask when you're shopping for a rate. Okay. So what's the par interest rate? That means without any points. What's the interest rate with discount points? Then you level the playing field. Right. When you go to shop your mortgage, then you know what you're looking at, and you can compare to them. But you level out the playing field, because the next lender, might tell you the rate's 6.5%. Right. That's without any discount points. Of course, you're going to go with the 5, but you don't know all of the details. Absolutely. So that's one thing. And then, communication is key in this process. So if you're having trouble, communicating with the lender just to get a rate quote, right, then imagine, what's going to happen whenever you get in the process. Yeah. It's not going to be a fun time. So pick up on those red flags in the beginning. Right. If you can't get a hold of them, then maybe it's not your person. I'm all for using a local lender. I feel like, online lenders are at your fingertips, and it's easier for you to, apply online, and they're in your face, online and on social media. But a local lender, you just don't get the same experience online as you do with, local lenders.
Explain to us, what are discount points?
So it's prepaid interest. Okay. So you can prepay interest. You can buy down the rate by buying discount points and paying that interest up front. Right. So typically 1 point, which is 1% of the loan, will buy down your interest rate probably 1/4 point. Okay. And so in a different world, the market that we're in right now, I'm going to tell you that that's probably not financially smart. Say that you buy it down, you pay 2 points, and your home price is, I guess, $500,000, or your loan amount is $500,000. 2 points is equivalent to $10,000, right? 1% of $500,000 is $5,000. So you pay $10,000 to get your rate from 7 to 6.5. Right. Well, next year or the end of this year, rates drop to the 5s and you want to refinance, you've already prepaid all that interest. You don't get that back. Right. So that's money, that's down the drain. So I'm not going to advise anybody to pay, an outlandish amount of discount points right now if you plan to refinance in the next few years.
Y'all, this girl knows her stuff. And I like it. I like it. All right. So now that we've talked a little bit about shopping for a mortgage, now what about the different types of mortgages available, and explain what percent each loan type an individual must put down?
Oh, yeah. There's lots of options.
Okay.
So I'll start by saying at the bank that I work at, there's 2 different types of lending. So we have our in-house commercial loan officers.
Absolutely.
Those are going to be the guys that do, land deals or hotels and commercial loans. They're also going to do, if a buyer is buying an investment property in an LLC, they're going to be the ones to do that. Okay. What in-house financing is we book those loans on the bank's books, and we service those loans here at the bank.
Okay.
So we're taking more risk, the bank is, by keeping them on the bank's books.
Absolutely.
And so the terms, the rates, the down payments are not as advantageous as what we do on the secondary market. So that's one side of the bank. And then you have us in the mortgage department, and we work for or on, I guess you could say, the secondary market. So we sell all of our loans to larger investors. So just like, Goosehead Insurance or somebody who's able to shop with several different, insurance companies, we're able to do the same thing from a mortgage perspective. So we work with 5 different investors that I'm able to shop a rate with and products with. Nothing changes, throughout the process because we sell those loans. It's all operates the exact same way. Somebody else is just servicing the loan after we close. But that's how you get the good terms, the lower down payments, the lower rates, the longer terms, is being able to sell those. So the products that we offer on our side is conventional, which is probably the most popular. If you're a first-time home buyer on a conventional product, you can put 3% down. If it's not your first time, then the minimum down payment is 5%. That's the most common, I feel like the most talked about product. A lot of people will go this route if they're putting 20% down because you don't have to pay PMI. You have the option to not escrow. There's more flexibility as far as that goes. With the government loans, you have to pay PMI no matter if you put 20% down, 10% down. It doesn't matter.
Absolutely.
You're stuck with the PMI. So conventional, those are down payments on that. Credit score, you're probably looking at 620 minimum on a conventional product. Appraisal requirements and stuff, they're more lenient versus if you're looking at it from a standpoint of FHA, VA, USDA loan, a conventional appraisal or appraiser is going to be less strict. So I know you probably recognize that, if you're selling an older home or, something that maybe an investor wants to buy to fix and flip, they're probably going the conventional route.
Absolutely.
So that they don't get picked apart by the appraiser. So conventional, then there's FHA, which is a government-backed loan. Honestly, probably one of my favorite loans to do. And I'll tell you why later on. But FHA minimum down payment is 3.5%. What a lot of people don't understand is these government loans have lower rates right now, much lower rates than conventional loans do. Almost a whole percent lower.
Wow.
If you're comparing a conventional loan versus FHA, your interest rate is probably almost a whole percent lower FHA versus conventional.
Oh, wow.
So a little, something to watch out for. As the rates are higher, people are looking for, they can get right now.
Always.
Yeah. I know, and that's what I'm thinking. Even when the rates were 2 and 3%.
Always. Absolutely.
Let's see, there's FHA, then there's USDA, which is a rural development loan, which y'all probably do, quite a bit of those in
Texarkana.
Absolutely. Yep. Those are tricky because there's a lot of rules that go along with those. So you have to be in a rural community, which I like to say, like outside of the city limits. It's a good, I guess.
So for us, that would be Nash, Hooks, Wake Village, New Boston, DeKalb. And there are some areas in Texarkana. So we have a map that we can use to pull up to see if that homestead or that property actually sits in that area. So we do get a lot of people that talk about, hey, I want to go USDA because I have to put 0 down. And I will tell them, there's a lot of red tape to get around USDA. And we have to be patient because that loan has to be like, they all have to be physically approved, but once it's approved here, it has to go to USDA and they have to put their stamp on it and say, okay, we're good to go.
Yep. And it takes a few days. Yeah. We got to send it to USDA and they have to give us the final approval on that.
Absolutely.
So you got to be a lender too.
No.
I love that you know that because some real estate agents don't.
Right.
And you're better able to help your customers if you know all of that going into it.
Absolutely.
We can only look in this certain area. The fact that you have those areas nailed down in your territory, that sets you apart than, a lot of other agents.
Absolutely.
But there's income caps on that too. So as a household income, that'll get you to is you can't make more than a certain amount depending what county you're in. So those factors all play in. The debt to income ratios on a USDA loan are stricter than
Yes, they
any
are.
other ones.
Yes, they are.
So, yeah. But like you said, it's 100% financing. So the perk is that you don't have to put anything down on
Right.
that loan. And I see it a lot of times where, especially in the market that we're in right now, where sellers are giving credits towards closing costs. And with the USDA, if you get a credit towards your closing costs and you don't have to put anything down, a lot of people are coming in with nothing at the closing
and actually
table.
getting money back.
Yeah,
possibly at
back.
the table. And let's talk about that. We'll talk about that last financing type here in just a second. So whenever you say closing costs, a lot of times we get first-time home buyers and just regular home buyers, period. They're like, okay, I want the seller to pay closing costs. And I will always say, I would love for the seller to pay your closing costs, but they're not obligated to pay your closing costs.
Oh, yeah.
But we do whatever we can to try to get the seller to pay closing costs. I have clients right now that are in California, and I'm selling their estate here, and we just closed on it. But that was one of the things that they said. They was like, they don't pay closing costs here, so why am I paying their closing costs?
Yeah.
So you have to sit down and talk to them and say, listen, this is kind of how real estate happens here in Bowie County.
Yes, and explain
per se.
That.
We do ask that the sellers pay closing costs. No, you are not obligated to pay the closing costs. However, in order to make this a smooth transaction, at least let's talk about it, and so then we start talking about different options. You can, if it's $8,000, the seller doesn't have to pay all $8,000. They can pay half of it, and bring the other half to the table. But you also have to keep into mind and take into consideration they're bringing either 5% down to the table or 3.5% down to the table. Plus you want them to pay their closing costs. That's a lot of money.
Yeah, and sometimes it's already a stretch.
It's a
just
lot
on the
of
down
money,
payment.
Especially in our community.
Yeah.
Where the average salary is, they're saying $28,000, but that doesn't necessarily mean that it is $28,000. I think I checked that a couple of years ago, but a lot of people cannot bring that to the table. And so I just do everything that I can to explain it. They are not obligated to pay your selling costs, but as your agent, I will do my best. So the other option is they just roll it into the amount of the loan. So if the property is $150,000 and let's say your closing cost is $8,000 and the seller decides that they do not want to pay your closing costs, then we'll write the contract if you agree for $158,000 and it comes out to be a wash in the long run. But sometimes you can't get people to understand we're rolling in your closing costs and they're like, oh, well, I don't want to pay $158,000. I'm like, okay, it may change your payment $16 to $50. Hardly anything changes. Yes. So you have to have an agent that understands the game
and can get creative.
You have to get creative. Because no two contracts are the same. Every single client doesn't need the same thing. And so you have to know how to adapt and adjust. 1 minute, and I just posted, I think it was Friday, like 1 minute I'm up and then the next minute I'm down. And then 1 minute I'm up. Like real estate is a roller coaster. And I tell people all the time, and I know that some people hate to hear me say this, but if I have to call and request an extension on a contract or whatever the case is, and I always just tell my clients, whether you're on the buying side or you're on the selling side, we do everything we can to get your loan closed, funded, all things done on the date of the contract. But if that does not happen, I just tell them this is real estate. And they don't understand, but I understand because I live it every single day. So closing costs, I'm glad that you brought that up. But let's back up to one more thing. Tell us what PMI is. I heard you say PMI.
That stands for primary mortgage insurance.
Okay.
So any loan that you don't put 20% down on, you're responsible for paying PMI. It's calculated different on a conventional loan than it is an FHA loan or a USDA loan. So on a conventional loan, if you don't put the 20%, you're paying PMI. And we have several mortgage insurance companies or vendors that we work with where we can shop that PMI to make sure that we're getting you the lowest, mortgage insurance monthly that you're paying that's out there.
Right.
So on a conventional loan, we're able to shop it. On FHA, it's a percentage times your loan amount. So it's 0.55% times your loan amount divided out over those 12 months is what you're going to pay monthly in mortgage insurance. On a conventional loan, once you have the loan for a little bit and you get to an 80% loan to value, you can do what's called a mortgage recast. In that they can take the PMI off of there.
Nice.
Just a little tip.
Yeah.
And usually you'll have to go to the mortgage servicer and request that to be done, but people do it all the time. With an FHA loan, it's on there for the life of the loan. You'll have to refinance out of an FHA loan for the PMI to come off, and you'll have to go into a conventional loan.
Girl, y'all, she know her stuff.
But, you're going to refinance anyways. Yeah. With the, if you have 7% interest rate and that drop to 5%, next year, you're refinancing anyway. So don't let the life of loan PMI on an FHA loan freak you out. Because the reality is you're coming out of it.
And we probably all have it.
Yeah.
At the end of the day.
Typically, it's not that much. Depending on what your loan amount is, if you're anywhere from, $100,000, $300,000, your PMI might be $100 a month. So we're not talking anything that's too crazy. But really what it is it acts as insurance for the mortgage company because you're not putting down as much money.
Absolutely.
And so they kind of tack that on there, and you'll pay that in with your monthly payment. So another little side note is if you don't put 20% down, you have to escrow. And what escrow is it's your property taxes and it's your homeowner's insurance in with your monthly payment.
It's just one payment.
Yep. And so, honestly, that's how I like to do it.
I think everybody.
Yeah, I don't really want to cough up, $10,000, $12,000 in property taxes
at the last minute.
Yeah,
that means we won't have Christmas.
I know, and it comes right at the perfect time. Right, we're Christmas, and you're coughing up everything else anyway.
Yeah.
But, USDA, and then there's a VA loan, which is for veterans.
Yes.
And also, I love this loan program as well. It's 100% financing, no down payments. And, it's for our veterans, and it's a great loan program, too. It's easy as far as, qualification, underwriting guidelines. Debt to income ratios are a lot more flexible than they are on a conventional loan.
Absolutely.
So those are just to name a few. There's more. There's what's called non-QM products, which are, if you got to get creative, there's 1099 programs. There's bank statement programs. There's DSCR loans, which are debt service coverage ratio loans for investors.
Yes.
We offer all those products as well. I don't do as much of those as I do, the primary stuff like conventional FHA, VA.
Y'all, listen, she knows her stuff, and she's so young. I mean, I'm just saying, she's young and she's on it, and I like it because you're the type of lender that I would send my 22-year-old son to if he was getting ready to buy a house, because I talked about this on the Sunday show this past week. I can't send everybody to talk to someone at such and such or this person. I try to match personalities because it makes it so much easier. And prime example, you called me not long ago and you was like, hey, I have this client. She's ready to purchase a house. And I was excited. And as much as I wanted to help her, I was not able to help her. And it was just a personality thing. That's all it was. And that's okay because I know that I'm not going to meet everybody's personality standards. Hey, look, guess what? We have some people that are commenting. There's your sister Hannah, and we see Aubrey. Hey, y'all. And also to our viewers, if y'all have any questions, please drop those questions in the comments so that we can make sure that we get those answered for you. All right, so moving right along, let's talk about what documents a potential borrower needs whenever they are applying for a loan and how important it is to make sure you get that in ASAP.
Yep. So important. So just a brief overview, income documents wise, usually I'm going to ask for 2 years tax returns. I'm going to ask for W-2s if you're a W-2 employee. I'm going to ask for probably 30 days worth of pay stubs. Just from an income standpoint, if they give me all those, I can analyze. I can see if you're paid commission from your pay stubs. I can see if you're self-employed from your tax returns. These are all important factors that will make or break a loan and need to be reviewed in the very beginning.
Say it again.
Say it again. It gets missed a lot. I see a lot of pre-approvals from big box lenders, online lenders, that are not actually pre-approvals.
Right. Because they have not turned in anything.
These are the loans that I have to go in and resurrect 2 weeks before closing.
Right.
And they're like, oh gosh, we went with an online company and now it's a mess.
It's falling apart.
And I come to find out, they never actually asked them for any income documentation in the beginning. They never pulled a credit report. And so then when you find a home, you put an offer in, you have your pre-approval letter, you think you're all good to go, you start the process, and then it becomes a nightmare.
Right.
They begin gathering the documents. It goes to underwriting, and they missed a lot of stuff that should have been reviewed in the very beginning.
Absolutely.
So if it might seem over the top to ask for all that stuff in the beginning, but that's just the way that I like doing business.
And let's talk about underwriting for a second. So whenever Madison or whoever receives your documents and they go through your documents from Madison, it goes to the processor, and then from the processor, it goes to the underwriter.
Yep.
Okay, I know a little bit, not much. So underwriters, I talked about them on the Sunday show. They're going to go under your fingernails, under your toenails. They're checking everything. And many of you don't know this, but just as we have a social security number, we have a mortgage identification number. And I don't even know if that's the right terminology, but there is a number that is assigned to you that follows you with mortgages, correct?
I mean, maybe, yes.
Yes. So you can go out and you can look and see, has this person purchased a FHA loan or whatever before? So I kind of call it like a mortgage social security number per se.
Yeah.
Because it's going to determine a lot of things. Yeah. Like if you can have a primary residence, you can have, other investment type properties, but you can't have like two primary residents.
You can't have two FHA loans.
Absolutely.
At the same time.
Absolutely.
Yep.
So,
and there's no hiding anything from an underwriter.
No.
When that credit report is pulled, you can see when did you have an FHA loan? When did it close? Is it still open? You can see the balance on that loan. And from there, they start digging.
Yes.
I mean, they want verification of mortgages on those loans. They want taxes and insurance. They want to see ownership. But you can see a lot of stuff from the credit report too that will show you, how many properties they own. But not only that, we pull what's called a fraud report too that shows maybe your mortgage is paid off, so it's not shown on your credit report, but you still have to pay those taxes and insurance on that property. The fraud report will populate any properties that you've owned in the past, certain amount of years.
Nice.
And it'll tell us if you still have ownership or not. So from there, we have to ask for the taxes and insurance.
Yeah.
Because you have to count that against them in the debt to income ratios.
Yes.
And if you're not that tight debt to income ratio, then maybe that's not a big deal. But for people who are, that could throw you over, and make you not qualify.
Yeah.
And so picking up on those things from the very beginning,
yes,
I feel like makes a nightmarish situation that could be just go a whole lot
absolutely
smoother.
Absolutely, because we've all been in those situations. I have been as an agent. I may start out with saying, we're going to use this lender, and whoop, we may have to change gears real quick. And I mean, I've had situations where we couldn't get closed with one lender, so I had to call another one and say, hey, this is what's happening. Do you think that you can fix this?
Can you pick it up?
And a lot of times, your agent has to be able to adapt and adjust really quick. You are a problem solver.
Yep.
And so you have to figure out how to solve this person's problems. Nick, who is our team owner, he says this all the time. Money exchanges hands when problems are solved. And I never really heard that before. And I'm thinking, you're exactly right.
Yep.
And all contracts and all loans, they're not all difficult. Some of them are easy breezy, but we do have those that are difficult, and we're like, okay, how do I fix this? How can I help this? And your mom and your dad said, great job. How can I help fix this, or how can I help push this loan forward? And sometimes we can push them forward, and sometimes we cannot.
Well, it goes back to how creative do you want to get? How hard does your lender want to work on to problem solve and figure it out? That's what's fun to me.
Yeah.
That's why I enjoyed this job. I get satisfaction out of problem solving and figuring out the loopholes and figuring out a way to get it done. I'll be bored if I didn't do that.
If all of them were the same.
Yeah.
If every single one of them closed on time.
Yep.
If every single inspection report came back okay. If we didn't have to terminate the contract because first time home buyer got scared.
Yeah.
As long as it's in the option period.
Yeah.
If we didn't have to do this, it wouldn't be fun.
Yeah.
It would not be fun at all. So I really do enjoy this.
Yeah.
More than you know. I get a thrill.
Yeah.
I'm like you. Okay, this is going wrong. I may vent. but I come back and say, okay, how do I fix this?
Yes.
And just knowing that I need to stay calm for my clients, because they don't know.
Yep.
They know what they know. And what
And
they
what you
don't
teach
know,
them, yeah.
they don't know. And so I do everything I can to make sure that I sit down and I'm teaching them and I'm talking to them and coaching them and holding their hands through this
Yep.
entire process, because it can get ugly at times.
Oh yeah, but that's my favorite part of it. Yeah, it's just being able to educate people, because like you said, they don't know what they don't know. And so having you're so valuable as a real estate agent. The fact that you take the time out to educate your clients.
Right.
You don't look at this just as a transaction
No,
or a way to make money. This is, we get so much gratification off of, or satisfaction off of, educating, seeing your first time home buyers learn all of this lingo.
Yes.
And knowing that when they go to purchase their next house, they got it down. They know what to look for. They know they're going to have to provide.
Absolutely.
But you just taking, it makes you even that more special that you take the time, to educate them and to problem solve when you need it. But back to the underwriting part of it, a lot of the problems that happen in underwriting can be avoided if you use the right lender.
Right.
When I started this 4 years ago, I really kind of got thrown into it, and it was like sink or swim. It was a really busy market, which that's how I like to learn anyways.
Yes.
Throw me in there and I'll figure it out.
Yes.
It was kind of during while interest rates were dropping super low and COVID was happening. Fun times back then.
Right.
So I got a lot of files just, when I first started, and had to figure it out on my own. And I had one bad one that I'll never forget, where it was about to fall out right before closing. And it's because of stuff that I didn't catch in the beginning, that I didn't know to look for.
Right.
And so after that loan, I made a promise to myself. I'm like, this cannot happen again.
Absolutely.
I'm not going through this and telling my buyers, like, this is not going to close. Like, you're not getting your dream house because I screwed up something.
Yes.
It's not the underwriter's fault.
Right.
It's my fault for missing it in the beginning.
Right.
And so I taught myself, actually, all of the underwriting guidelines. I mean, there's thousands and thousands of pages. And each loan is different. It has different guidelines, and rules for each loan. I went in and taught myself all of those guidelines. So I know exactly what to look for in the beginning.
You go, girl.
If I see red flags or something that I might need in the, that I think that I might need throughout the process, or the underwriter might need later on, I'm getting it at the beginning.
There you go.
I'm ordering verifications, mortgages, verifications of rent, all of that stuff in the beginning before it goes to underwriting, so I can catch anything.
I like it.
And my, the conditions that come back from the underwriters are usually pretty simple.
Yeah.
On my loans, because
normally it could be something as far as an appraisal.
Yeah.
Something that they found on the appraisal. It could be, okay, I have this. I may need some student loan documentation. It could be child support. I mean, it's a number of things that can come up that may seem like a red flag that may not always be a red flag.
Oh, yeah.
So I've had one, and it was on an Arkansas transaction where a whole lot of child support came up. But the child support, that client was it's coming out of his paycheck. And so, we're like, okay, why is this not reporting to Arkansas? So we ended up having to file an extension, and they tell us it's going to be anywhere between 2 to 4 weeks before they can get all the stuff back. And so we were able to get that pushed, and all along he was caught up.
Yeah.
But they were not reporting the things that they needed to report the correct way. And so there are times when you find things. I had another one where it was a student loan situation, and it was, a very small amount. It was only like $1,800 or $1,900 that showed up on something in the background with underwriting, but it was not on the credit report. So you talked about that a little bit. And so when she caught it, it made a difference. $1,800 made a difference.
Oh, yeah.
And so that's why you have to make sure that, you catch all those things up front.
Yeah.
So
you
made
provide,
a very good point.
Provide more than enough documentation in the beginning. We don't have to provide all of that we don't have to provide all that to the underwriters, but at least provide it to me.
Right.
And we can kind of decide what we want to show and what we don't want to show, but at least give me an idea of what we're working with.
Absolutely.
So that I can, better help this process go smoothly.
Okay. Tell me, typically, how long does it take for you to close a transaction?
Well, sometimes my answer might be 30 days, but I work on the real estate agent schedule. So I had a realtor come to me, let's see, 2 weeks ago, and I had just closed a deal last Friday, and the contract was written for 2 weeks. So I had, a week and a half or a week to get it clear to close. Easy breezy, got that knocked out. So out here we move a lot faster than we do in Texarkana.
Yes,
I know y'all spend some time waiting on the appraisers, the title companies. No offense to any of them,
Absolutely.
but they move at a slower pace than we do out here. So I think the appraiser went out the very next day after I ordered it, and we got that back in. I had already gotten all the income documentation, credit report, all that kind of stuff from the borrower, and we had kind of gotten a game plan together so that we could close it on, in a quicker time frame. But I'm open to whatever. If you need to close in 15 days, we'll figure it out. I mean, I'm your girl. We will get a game plan together and get it knocked out.
I like it. All right. So do you have any additional tips that you want to tell the audience about with helping them navigate through the process?
I think that it's never too early to get started. I'm talking like even 6 months in advance if you want to. If you know that you're trying to buy a home maybe after the summertime, let's start now and get a game plan together. I don't have to pull a credit report. Come to me with a list of what your monthly debts are. Okay. Let me look at your tax returns and make sure that we're looking good there. But if you come in advance, we have enough time to prepare, and get a plan together to make this process a whole lot smoother. I tell people, some programs like conventional loan, you don't have to use bank statements. There's ways to avoid using bank statements. And so one of my favorite things is a lot of people get gifts, and a lot of people will move their money out of their 401k or their stocks to use as a down payment. If I see that on those bank statements, which we're going to have to get 2 months of typically on any government loan, if I see that on those bank statements, the underwriters are going to want to track that. They want to see where that came from. They want to see if you got a loan out. It just
So you're telling me I can't pull the money from under my mattress to buy a house? Is that what you're telling me?
Oh my gosh.
Everything has to be documented.
Everything has to be documented.
Oh my goodness.
It's a pain, but there's ways to work around doing that if you start the process early enough. So if you're going to move money around, move it around, 3 months in advance and get that done so that I don't see it on those bank statements.
There you go.
And so the earlier that you start, the easier the process is going to go. And work with people that like, and trust.
Right. All right, Madison, you have done a wonderful job. So please, please, please tell the audience how to get in contact with you. We know that we have been running it across the bottom of the screen, but tell them how to get in contact with you.
Yes, I was going to say, I think I see my cell phone number, my email address. Call, text me anytime, email me anytime. I'm happy to help. I feel like I work all hours. I work the same hours as a real estate agent does. So let's see, what is that? 12 hours a day and 7 days a week. So call or text me anytime. I'm happy to help. You can go online to, I think it's farmersbankandtrust.com, and there's a mortgage department tab on there, and you can go to my section. You can apply through a link specific to me, and it'll come directly to me. There's also other originators, Jade and Kim, who are in Texarkana. Their profiles are on there as well. I also have social media. I'm not as good as Monica is at social media, but maybe one day I'll be that good. So you can follow me on social media. It's some work and some personal, all combined on those platforms. But yeah, just, connect with me on anything and anywhere, and I'm happy to help.
All right. So now I'm going to hit you with some rapid fire questions.
Okay.
Pink or purple?
Pink, all the way.
Cat or dog?
A dog.
Okay.
I think I'm allergic to cats.
Beach or?
Beach. I don't need to know what
Lord
my other
Jesus.
option is.
Okay. Mercedes or BMW?
BMW.
Okay.
I got my own one too.
Okay. Townhouse or condo?
A townhouse.
Okay. You like conventional or FHA loans?
I said FHA earlier. I guess I'll stick with that. I mean, conventional is what I do the most, but I feel like FHA is sometimes not understood.
Okay. Shredded cheese or sliced cheese?
Shredded.
Okay. All right. Well,
On some
Madison.
tacos maybe or something.
Yes,
You
that
know,
sounds
you're getting
so
you're getting me
good.
hungry now.
All right, y'all. Well, unfortunately, we are out of town with this first episode of the Monica Kelly Show. I want to thank you all so much for tuning in. Thank you for being patient. We were late. I was late. But I just want to say thank you so much. And please check me out again next week. I will be back with another guest in the studio, and I hope to see y'all next week. Bye now.